Alright, hello, welcome to a new video. In today's video, I'm going to be talking to you guys about what an FVG is and how we can apply um, FVG theories or like fair value gap theories with the markets. So let's get right into it. So what is an FVG? An FVG is essentially it is a 3 candle pattern that it's basically an inefficiency. So it's when prices moves in one direction, in a certain direction, and the middle candle body creates a gap between the first and the third candle's wicks. I'll show you guys that with the picture. So when we look at prices on when we look at prices, we always looking at what side or what are we targeting. Like, are we strong sell side, buy side? And essentially it is fair value gaps. You can gauge the strength between if one side is stronger between the other side. So like here on the monthly time frame, you can just from the looks of it, we are stronger on the upside. We go on to the 1 week time frame, the weekly time frame, and now look, this is basically what a fair value gap looks like. This is a fair value gap. So notice how this middle candle's body is extremely big, and the first candle's wick doesn't intersect with the third candle's lower wick. So this would be called a BISI, buy side imbalance, sell side inefficiency. So that whole entire range right here between this candle's high and this candle's low is a BISI, and that indicates to us that we are strong on the upside, and that we are favoring bullish conditions, higher time frame wise on the weekly time frame. So how can we how can we dive even deeper into what a fair value gap theory is? So which is that is essentially what a fair value gap is. And here I want you guys to look at these two drawings that I have created here. So there's this first one, this one right here. So can we anticipate for prices to take out this candle's high first before retracing, or will we leave this high here intact and take out this low? So the way that I view prices, according to how the left side structure is built, we can anticipate for prices to take out this candle's high before retracing. And on the right side, in this example, we have essentially basically the same thing. We have a fair value gap here, but instead of taking out this candle's high, we can anticipate for prices to take out this candle's low, so retrace back into the fair value gap before continuing higher. So what can we, from that understanding and just from that, that concept, this is essentially what a breakaway gap is. The differences between when you understand what a breakaway gap is and how you can view when a fair value gap will be left open or when the fair value gap will not be left open. So here we can tell that prices are stronger, and on the right side we can tell that prices might not be as strong as we think we are, and we might need a rebalance price before trading higher. So understanding, so this is like basically a written explanation of what just happened on the previous slide. So on the left side example, from what we can see, the third candle closed above the body and wick of the second candle. So we closed above this candle's wick and this candle's body, so we close above the second candle's body's closure and the wick as well. And we can anticipate for prices to take out the third candle's high and it indicates strength, and we will likely not retrace back into that time frame's fair value gap. What I mean by that is that we could, so let's say this is the 1 hour time frame. We maybe on the 5 minute time frame, we might retrace back into 5 minute time frame within this hourly candle, and we might retrace back into the 5 minute candle, 5 minute, FVG, and then take out this candle's high. But we will not retrace back into this candle's into the 1 hour FVG, and we will most likely retrace back into only the 5 minute FVG, just from based on how the closure is, All right, and on the right side, I noticed that we closed below the second candle's closure, so we closed below this candle's closure right here, the second candle's closure, and this is showing signs that we will most likely retrace back into the fair value gap that is created. Most likely will not take out the third candle's high, but rather take out its low. So like I said, we will leave this high intact just based off how this candle's or this structure is created, and we will take out the low instead of the high compared to this left side example. We can use this thought process to align ourselves with order flow and even structure a trade from this. This is what I mean by, this is what it means when sometimes we will leave fair value gaps open. ICT never really went into depth with what he means by breakaway gaps, but this is my understanding for it. So he never spoke a lot about, the creation of fair value gaps. It was mainly more of like, let me see if I can find an example. Like he might have said something like, what can I use as an example? Here, like we can say something like this, how we closed here. Like he would have said something like, oh, because we came into this inversion fair value gap, we shouldn't trade back into this FVG anymore. This FVG should be treated as a breakaway gap. Blah blah blah. My understanding of it is purely based off of how this structure is created right here. Breakaway gaps. This is how I understand how breakaway gaps are created. Sometimes we can allow for retracements only if the objective has not been taken out yet. So a good example of that is such as here. So the trade objective, the objective for this trade essentially is to take out this hourly candle's high, and here we are. So this is the hourly high right here. This is the hourly high, and we never took out the high yet before retracing. So our this is what I mean by we can allow prices to retrace back inside the FVG before taking out the objective. And the creation of a fair value gap in itself is a pattern if you pay attention to how each candle closes and wicks. That is essentially going back to how I showed you in this example right here, how this fair value gap is completely different to this fair value gap. This fair value gap that's created here will most likely be tapped in and continue higher, and this fair value gap will be left behind, and then we will most likely attack this candle's high first, and then maybe some buy side liquidity above here before retracing. All right, and so a subtopic of the fair value gap theory, or the fair value gap theory, is the consequent encroachment. The consequent encroachment is taught by ICT, and it is essentially, it's the midpoint of a gap. Fair value gap, a new day opening gap, a new week opening gap, regular trading hours gap. Yeah, it's basically the midpoint, and when prices, it should be a very sensitive spot for prices. It's very sensitive. So prices should react to basically the consequent encroachment of the fair value gap. And if it doesn't, then it means we might be disrespecting it. So CE, which is consequent encroachment, is the midpoint of any fair value gap, wick, RTH gap, new week opening gap, or new day opening gap. When prices shows respect to that level, we can anticipate accuracy and strength from the market. We can gauge the strength of a market depending on how deep the retracements are. So let's say prices retraces back into a fair value gap, but we only tap, we only retrace back into like the upper portions of this fair value gap here in this example. That means we are bullish, like we are strong. But let's say we retrace all the way back to the low end of the fair value gap. That means we might not be as strong as we are, as we thought we are, and that we might continue lower. So yeah, it allows us to gauge the strength of the markets of whatever we're trading, and whenever we get a reaction to the consequent encroachment, that shows that there's accuracy, strength, and it also shows that there is an algorithm in the markets. Alexa, turn off my bedroom light. There are numerous occasions where where we can dig deeper past the consequent encroachment, but you always have to pay attention to the candle closure. The candle closures will tell you a lot. If we trade back below a 4-hour fair value gap on the 1 minute time frame, but on the 4-hour time frame we actually close above the consequent encroachment. That's just wicks. Wicks do the damage, and the bodies tell the story. That is a line straight from ICT, not me. So such as in this example right here, notice how, so this is the 30-minute fair value gap that I noted out here, and look at how prices react to that concept. Look at the wick. We wick right into the midpoint of this fair value gap, and we continue lower. Like I said, it shows that we have strength to the downside. The algorithm is in fact running right now, and yeah, I there's not really much it's very, very, very sensitive. Just keep in mind that the consequent encroachment of a fair value gap is a very sensitive level. And even in this 15-minute fair value gap, that the 30-minute fair value gaps within, notice how the bodies of the candle close right below the consequent encroachment of the 15-minute fair value gap. That isn't random. That's the algorithm doing its thing. It's basically prices showing its hand to you. It's like, hey, we might be wicking a little bit past the consequent encroachment, but notice my body. Pay attention to how the bodies are created. In another example, on the 1 minute time frame, in this 5-minute fair value gap on the 1 minute time frame, notice how the 1 minute candles bodies are. Look at how none of these bodies are closing below the 5-minute fair value gap. And this wick right here, we actually wicked right to the low end of the 5-minute fair value gap, and we just continued lower. We never got a candle closure below the consequent encroachment on the 1 minute time frame. Very, very sensitive area. Another topic that a subcategory of the fair value gap theory is the inversion fair value gap. I use this pattern to it's like almost basically like an market structure shift, but for fair value gaps. It's a market reversal pattern, and when it will show you when the tides are shifting, when we are continuing lower, but as soon as we get a closure below or above, a SIBI, if we get a closure above a SIBI and we're bearish, that just means that we might be reversing, or we might be seeking higher prices to continue lower. So an inversion fair value gap is a fair value gap that is disrespected and should be now respected to help support the opposing price direction. So what I mean by that is there is this trade here. So on the 5-minute time frame, right? So we're continuing lower here. This is the 5-minute time frame. So we come into a 5-minute fair value gap. We continue lower. We come into another one and we continue lower. But notice how we create another 5-minute SIBI, but we completely disrespect it. We close above it, and we created BISI on the buy side, side. That is showing, hey, we're disrespecting the bearish as of currently right now, and we might be attacking higher prices. This concept can help indicate and support the idea of a market reversal. When ICT states that sometimes he doesn't require a market structure shift on his trades, I believe this is what he meant by that. When we see, a disrespect to a fair value gap that should have sent us lower, but we close above it, that will help indicate a market structure shift. So sometimes we don't need to see a market structure shift for there to be a smart money reversal. We can just have a creation of a inversion fair value gap to indicate the smart money reversal. So it is a higher probability inversion fair value gap once we close above it on the time frame we created it on. So basically what I mean by that is, notice how we created this SIBI on the 5-minute time frame. We also closed above it on the 5-minute time frame. We didn't just close above it on the 1-minute time frame, but we closed above it on the 5-minute time frame. That helps, that really confirms that, and patents that idea of, hey, we might be seeking higher prices at the moment. Alright, so it is a stronger inversion fair value gap / idea when there is a fair value gap that subsides within the inversion fair value gap. So for example, a fair value gap in inversion 5-minute, a 5-minute inversion fair value gap that has a 1-minute fair value gap within it will be stronger than just a inversion fair value gap alone. So I like trading fair value gaps, but I like using the idea of an inversion fair value gap to support my narrative, my trade idea, my trade objective that I want prices to reach. And in this example right here, so this is the 15-minute time frame. We closed above a 15-minute SIBI. So what is this orange shaded area now? It is an inversion fair value gap. And we can go on to the lower time frames, and even that, like, look, even on the 15-minute time frame as well, we created a 15-minute BISI, a 15-minute BISI within a inversion fair value gap. That just supports the idea, the narrative that, hey, we might be going higher, attacking this buy side here. And another one. This is a 5-minute 5-minute fair value gap, and we closed above it. So closure above a 5-minute fair value gap after tapping into RTH gap and 15-minute fair value gap. So, like I said, the inversion fair value gap, you can use it as a trade entry or a trade confluence. I prefer using it as a confluence because my main PD array that I use are fair value gaps, not inversion fair value gaps. They're a little bit different. They're the same. Necessarily, it's basically the same thing, but once you look at it in a different perspective, it's it's very different. So like I said, we close above a 5 minute SIBI, and now it turns into an inversion fair value gap, and we also have a 1 minute fair value gap within that inversion fair value gap. So it's a lot stronger than just it than the idea of it just being a inversion fair value gap as well. It also has a fair value gap within the inversion fair value gap. Sorry, that's kind of too wordy, but just pay attention to this example. All right. So the next and the last subcategory of what a fair value gap is displacement. Displacement is a strong energetic move, and it should be away from, it should be like created. Displacement should occur when prices tapped a key level, a certain PD array on the higher time frames, and we might see displacement on the lower time frames relative to that higher time frame. So let's say that we come into a 4-hour fair value gap. We could have displacement away from that 4-hour fair value gap on the 1 hour time frame, the 30-minute time frame, or the 15-minute time frame. And as traders, we never want to trade the displacement leg up. We always want to trade the retrace back into that fair value gap that's created. And one of my main rules for displacement is my rule. It might not be yours, but the way I view displacement is that if there is no fair value gaps, there is no displacement. You want to keep it simple. Have rule sets for yourself, and this is just one of my rules is that if there is no fair value gaps, there is no displacement. And if there's no displacement, I will not take a trade. It's as simple as that. And you only want to take a trade when there is displacement. Like I said, no displacement, no trades. This will prevent you from having, unnecessary losses. You might see, you might be skewed in one way, like, oh my gosh, we're gonna take out this high, but what are we gonna, tap into or retrace back into for us to take out that high? And displacements, it will, it will limit the amount of trades that you take, but it will also increase your win rate, because if there's no displacement, you don't trade. So, and displacements are also like I said, it's also just like how I said about the consequent encroachment. It is the market's showing you its hand. When will prices do this? Prices might slowly climb up the chart and make it seem like we're tracking previous day high or whatever, but that slow move up has no fair value gaps, and we can just dump back down. But the markets will show you its hand by that displacement, those tons of that massive order rush that comes into the market, and that creates that displacement, that energy, the strength, and then so that will allow you to know when you should enter the trade. You want to be trading with the banks, not against the banks. And displacements is basically, like I said, it is the market's tipping you its hand, like, hey, this is when we're gonna do this and that. You should come in now. And you always want to think of displacement as like, this isn't my example. Credit is to ICT. This helped a lot with my learning curve. So imagine displacement as like dropping an elephant into a swimming pool. You think of the overwhelming overflow of water that gets created after that happens, or when you drop an elephant into a pool, you see the water is gonna rise, and it's gonna maybe create a massive wave, a massive splash, and just an abundant of water just comes out of nowhere, the same thing, apply that thinking as displacement. Think of it as the banks are, sending tons of just massive orders, boom, 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 and all that massive amounts of orders creates that displacement, that willingness to go towards a certain level. And as a day trader, we want to trade that displacement leg or that wave. And here is an idea of understanding, of using displacement in your trade. So on the hourly time frame, we had a displacement, right? There's a fair value gap. We displaced from this 4-hour FVG here, and we create another 4-hour FVG one that's also has a 1-hour FVG within it. So you never want to trade the first initial displacement leg up. You want to trade the retracement into that fair value gap that was created. So we retrace back into that 4-hour/1-hour FVG, and we get a willingness to go away from it just looking at how this 15-minute candle closed and how this 1-hour candle closed. So this hourly closure, we tapped into a 4-hour fair value gap, and we get this sort of closure on the hourly time frame. So with how this candle looks, we can anticipate for prices to take out this candle's high. And even on the lower time frames, on the 5-minute time frame, it's all fractal. So notice how we create this fair value gap after displacing away from this 4-hour fair value gap. Prices are fractal, so when you go down time frame, you go down to the 5-minute time frame, we had displacement again. We displaced again away from the 4-hour/1-hour FVG, and we create a 5-minute fair value gap. All right, and you want to take that, like I said, you don't want to take the entry at the displacement leg. You always want to wait until the retracement leg, and the objective of this trade was to take out that previous hourly candle high, and you can enter at that 5-minute FVG and target the hourly high. So with that, that's basically all I have for fair value gaps. I hope that helped you guys understand fair value gaps a little bit more. We talked about how breakaway gaps could be formed, and how fair value gap is like a pattern. It is also PD array that and it's my main PD array that I trade with. I don't trade with order blocks. I don't trade with breakers. My main PD array is a fair value gap. I talked about the consequent encroachment, which is the midpoint of a fair value gap. I talked about the inversion fair value gap and how it is used as a market reversal pattern, and I also talked about what displacement is, and how when there is displacement, then that means you can hopefully enter a trade, or if your rules set aligned, then you can take the trade, and if there's no displacement, you will not take a trade. Simple as that. Keep it very simple. And yeah, that's it for my fair value gap video. If you guys have any more questions or have any questions, type them down in the comments below. I can make another video over fair value gap, and hopefully explain it a little bit clearer, but I am explaining it with the idea that you guys already have a basic understanding of what fair value gap is. I'm just touching up and making it a little bit cleaner, making those edges a little bit sharper of your understanding of a fair value gap. And I'll see you guys later. Be safe. Boom.